Yes, thank you, Caleb. So my name is indeed Paul, and I am indeed a structural engineer. However, I've done several things throughout the years, including running an organization called Sensible Money. So how Sensible Money came about was back in 2009, there were rumors of a global financial crisis, and I started investigating exactly what the root cause was, trying to get a sense of how long it might last, etc. And it occurred to me that in the real world, we had lots of good real-world ingredients for having a high-functioning economy. We had all the entrepreneurs, all the workers, we had all the materials, we had the infrastructure, we had the energy sources and so on. We just seemed to lack a medium of exchange to allow it all to flow. So it was that medium of exchange that I focused on, or money. And in particular, I looked at the source of digital money or electronic money, exactly how that is created. In discovering that, I realized there's some problems with that system, discovered various other methods by which we could create electronic money in better ways. And I set up Sensible Money as a result, as a means of trying to promote some of those ideas. Now, pretty quickly, the conversation changed from trying to promote the ideas just to educating people about exactly how the current system works, because the process by which money is created is very much misunderstood, even amongst economists, but especially amongst the layperson and politicians and so on, understandably. So when we would meet people, we would pose a very simple question of, where does money come from? Now, the obvious answer is that money is printed, and sure enough, a small amount of money is printed. In a developed economy, that's about 3%, but the other 97% exists digitally as the numbers in our bank account. So that's what money looks like in a modern economy. It's the numbers in our bank account. And it's that type of money that I really focused on, exactly how that is created. And the best answer to that question is that digital money comes from bank loans. So if you get a loan from a bank, it's not actually a loan of pre-existent money. It doesn't come from other people's deposits or from anyone's savings or from central bank reserves. Banks create the money for the loan by typing a higher bank balance into your account. Now, that being the case, there are two pretty direct consequences of that. One is that every dollar has to have a corresponding debt. So money is created throughout the loan process. They type money into your account. They record a matching debt back to the bank. So every dollar has a matching debt. The other consequence is that in order for there to be new money in the economy, someone has to walk into a bank and organize a loan. And if there's a disturbance to that process, then we have problems. Now, not everyone thinks it is that simple, but I'll try to prove it in a couple of different ways, 3 different ways. First of all, just some quotes from people who should know what they're talking about. So, here we go. Banks extend credit by simply increasing the borrowing customer's current account. When banks make loans, they create additional deposits for those that have borrowed. Each and every time a bank makes a loan, new bank credit is created, new deposits, brand new money. Money is primarily created through the extension of bank credit. The commercial banks can create money themselves. And finally, from Mervyn King, the Bank of England, when banks extend loans to their customers, they create money by crediting their customers' accounts. Now, just to prove it through accountancy as well, let's imagine you want to organize a personal loan of, say, $10,000. So you walk into the bank, you fill out all the forms, they do all the background checks, they check their balance sheet, your future income, etc., the central bank numbers, and finally gets to the point of them approving the loan, and they get to that point of extending that loan to you. So you notice that your bank account suddenly reads $10,000 extra. So in accountancy terms, your bank account is a liability of the banks because technically it's a record of how much cash they're willing to give you. So when they increase that account, they make a credit entry to the liability side of their balance sheet. And on the asset side, they now suddenly have you as a debtor. You're promising to repay $10,000. So they make a debit entry to their debtor's account. So that's it. 2 accounting entries go up and everything balances, but money has been created in the process. Now, nothing else would make any sense from an accountancy point of view. Notice that no one's account goes down. Like there were several bank loans made today, for example, but my deposit account reads the same thing. My savings account reads the same thing. The central bank reserves read the same thing. No one's account goes down when a bank loan is made. Now, finally, everyone in this room, we all have bank accounts. All our money is in there, aside from a little bit of cash and coins. Any significant amount of money that we have is either in our account or within an investor's account who we've invested in. Basically, all of the money of the economy is already in the bank. And yet, who in this room owes money to a bank? Okay, so pretty much everyone. So that makes sense in a world in which banks create the money they lend. But it wouldn't be possible in any other system. It wouldn't be possible for all of the money of the economy to be already in the banks, and yet everyone in the entire economy to also owe lots of money to the banks. And now I want to talk about the money multiplier model of banking. So this is the nearest that economics comes to explaining how banks create money or how money is created. So the story unfolds as follows. Let's imagine we're forming an island economy tomorrow, and on day one, there's no money between us. And on day two, the government prints $100 and they spend that into circulation. So one of us has that $100. So that person walks up to a bank, deposits that $100. The bank takes the physical cash, they put it into the vault, and they open up a bank account for that person, and they write, they open up the account and they just write, $100 is your bank balance. Now, if a second person comes along and wants to borrow some money, the bank will look in the vault. Yes, we have some money. We'll keep a little bit aside. Let's say we keep $10 aside, but we'll take out 90. And here you can borrow that 90. So even though the government has only created $100 to begin with right there, so on day one there was $100 in circulation, now there's effectively $190 because one person has the physical 90, but the first person has a bank account that reads 100. And in today's world, that is more liquid even than the cash itself, because you can use a debit card or an app or whatever it is to transfer that money. So in doing so, the banks kind of indirectly create money is the idea. There's now effectively 190 in the economy, and that cycle can repeat and so on. Now, that's a pretty poor model of banking. It would only actually apply if every bank loan was processed in cash form. But it is remarkably resilient. So I've got some examples. So while individual banks cannot create credit, the banking system as a whole does exactly that. Just not true. Credit institutions' total domestic deposit liabilities traditionally have been the main source of mortgage supply. Well, no, mortgage supply is just funded by the banks directly. Much of this funding was sourced from the United States, just not true. Banks are at the center of the credit intermediation process between savers and investors. It's just a very poor description of banks' process in the whole system, and yet it just crops up in economic journals all the time. This is what economists believe. Now, an even better question is, how does money disappear during a recession? So a certain amount of money is saved during a recession. So if we all rein in our spending, it can just feel like there's an apparent lack of money. So sure enough, money is saved during a recession. But a far bigger contributor to there being less money during a recession is the fact that money is deleted as loan repayments are made. So just to go back to our example of the $10,000 personal loan, you walk into the bank, you get the approval, you look and your bank account suddenly reads 10,000 extra. Your record of debt to the bank reads 10,000 extra. And let's imagine you just instantly changed your mind. So you wanted to just use the money that you just borrowed to just instantly pay that loan. So you instruct the bank accordingly. So they lower your bank balance by 10,000. They lower your record of debt to them by 10,000. And that's it. As two accounting entries go down, the money that was in your account just doesn't exist anymore. So each and every time you repay your mortgage, for example, you are destroying money. So some examples again. Every loan, overdraft, or bank purchase creates a deposit, and every repayment of a loan, overdraft, or bank sale destroys a deposit. If all bank loans were paid, no one would have a bank deposit, and there would be not a dollar of currency or coin in circulation. And finally, Mervyn King again, when the banking system, or what the banking system has been doing, is destroying money. Now, if anyone wants to know a bit more, I've got various papers and things written about it, so my email address will be on the last slide. I've got a couple of guides to the whole system. Depending on what level of nerdiness you have, there's ones with accounts and ledgers and balance sheets and credit entries and liabilities and all sorts. And then there's a friendlier one as well. Now, what are the consequences of this? Well, this is the reason, this simple little process is the reason that you're struggling in life and you hate your job. There are lots of indirect consequences of this, but I will just focus on a couple. So one would be housing crises. So the blue and the red line are closely correlated. That's population and housing stock. And you would expect that house prices to be somewhat stable under that system. But that green line, the house prices, just poorly correlated with those two lines, whereas they are pretty well correlated with the purple line, which is the amount of money that banks were putting towards or creating towards house loans at that time. So house prices just don't form or don't conform to the usual supply and demand laws. You can't lower the price of houses by building more houses. That's one little consequence. Now, we haven't had this system for very long, really. It's relatively young. So back in the 1920s, we had a roaring economy that was primarily cash-based. Then we had the Great Depression, and that lasted about 10 years. And to get out of the Great Depression, the American government were advised by the economists of the time to issue government bonds. So government bonds were promises to repay the investor all of the amount that they've invested plus a bit more, quite a bit down the line. So people had confidence in that system. So anyone who had savings would buy these bonds. That meant that the government had money and it spent that on infrastructure, and that got the whole system going again. And when I say that got the whole system going again, I really mean that meant people had confidence to walk into banks and organize loans. That's what's needed to get the whole system going again. Now, after the Second World War, we started taking on personal debt. So that was a little bit unusual. Prior to that, it was primarily businesses or governments that took on debt. But then we started getting mortgages, and the first mortgages took one income about 5 years to repay. Then it was 10 years, then 15, then two incomes got involved, and we're now at the point where it takes two incomes about 30 years to repay a mortgage, and it's somewhat of a natural limit to that thing. But I have a little graph of the money supply globally, or the amount of money in everyone's bank account collectively globally since the 1980s. And you'll see that since the 1980s, the amount of money in the economy has had to double about every decade to keep the system going. That's primarily being funded by that idea that mortgages just take longer and longer and we take on more household debt. I would think we're sort of at the point where no one in the economy really, like households or businesses or indeed governments, is in all that good a position to be taking on more debt. Another point to this graph is that this is a highly inflationary system. For something to double every decade, it goes 10, 20, 40, 80, 160, so on. It's a hugely inflationary system. Now, normally the inflation is seen in stock prices or house prices, but we don't tend to call that inflation. If we can't get inflation in stock prices or house prices, then we get inflation in the price of a loaf of bread, and we do tend to call that inflation. But what I think is alarming about this graph is that to keep the system going somewhat smoothly, we need to double the amount of money in the economy every decade. It means that people have to walk into banks and borrow ever increasing amounts of money each year just to keep going, and particularly because of that mortgages at the end of their natural life sort of thing. I just struggle to see how it's going to go smoothly from now on. So it poses the question of where to next. Well, there are several ways in which we could create the nation's money in better ways, but here is one. So I would call it the plain money system of banking, because it should be reasonably straightforward. Basically, it means running the economy the way everyone thinks it runs. So we would have current accounts or checking accounts or your everyday account. So if you have one of those, only you can use it. And we would also have savings accounts. So if you open up a savings account, you're basically foregoing any money in there while it's in there, and only the bank can use it. So, I'm going the wrong way, am I? Where would money come from? Is the next question. So the central bank would decide how much money to create. So they would control inflation, and they would look at things like population growth would be a big one, and decide how much money to create. And they would just type that into the government's bank account. And from there, the government would control budgets and also just decide how best to spend new money. Now, under this system, money would never be deleted. So once we just create money, it would never be deleted. So these wouldn't be big. Once the system's kind of reached some sort of a status quo, these wouldn't be big powers that either of those institutions would have. Now, talking a bit more about current accounts, there'd be no risk to a current account. If you have money in there, it's just perfectly safe. Hence, a charge would apply probably, because banks would still have to make money somehow. If balances move upon a bankruptcy, meaning if your bank you're with went bankrupt somehow, you wouldn't be worried at all. Whatever was in your current account would just go to one of their competitors. There'd be no bank runs, no deposit insurance, no bank bailouts. Savings accounts, though, these would be quite different. So a risk would apply, because if you put money into a savings account, that would be the investment pool that the bank would use to actually lend out money. So in case if a bank loan was made, one person's account would go up, but that savings account would go down. That money would be gone, essentially, would be out there. Some money will be added to the investment pool, and banks would consult before investing. So that'll be one little advantage to this system. At the minute people deposit money or open up savings accounts, thinking that money goes into a pool to be lent out. But that's not how the current system works. But under the proposed system, that would be possible. So I've got a guide to the plain money system of banking. So again, feel free to email me at the end if anyone wants to know a bit more. It's from a Eurozone perspective, because I'm from Ireland, in case you didn't realize. But finally, it's Nerd Night Pun time. So I have written a book about all these things, which is currently sitting on my hard drive awaiting being published. But in there's some crackers. Because it's not feasible, or perhaps feasible. We accept the bank's liabilities, or liabilities. And finally, my favorite, resolving the Great Depression came through converting self-interested lone rangers into self-interesting loan arrangers. Okay, that's it, everyone. I'm open to questions. Yes, question from Matt at the back.
Yes. Why do you think that the system doesn't change the plain money system?
I would think for a number of reasons. We're pretty invested in the current system, no pun intended. There's just no interest in the current system. I wouldn't bank on it, Matt. Oh. No, there's a number of challenges. So I ran Central Money between 2010 and 2014 and presented these things at various economic conferences. And had articles in national newspapers and met some really prominent economists, because Ireland's such a small place, you can just email them, and met loads of politicians and various talk show hosts and so on. And yeah, just lots of stumbling blocks. It was very hard to get the message across that the current system is misunderstood in the first place. And it's just such a big system. To try and change it wouldn't necessarily be overnight. So very hard to spark those conversations, really. Yeah, very challenging.
Building on the previous question, if we all, worldwide decided that we wanted to change to the other system, who does it? What parties are involved to make the changes? Of banks or governments, or who would be the people you wanted to?
Yeah, so if you read the book, you will know, or the guide even. So transitioning would be, the mechanics of the accountancy would be slightly tricky, but have got a section in there about that. But if it did transition, it would probably just be one economy that would do that at the start, and then it may filter worldwide. So to have this system of money creation in conjunction with the current system, that is problematic, because the current system's so relatively inflationary compared to the proposed system, but do have ways of working that out. But more to the point would be how it might come about. So I would think it would eventually come about from economists advising governments of this. So similar to how had the Great Depression for 10 years and then someone suggested government bonds. They weren't a new idea or anything, but it was just something that someone presented, and it was music to everyone's ears. So equally, there is some things here that would be music to everyone's ears. The idea that the central bank could just create money debt-free and just give it to the government, and that would be a legitimate step, and the government could spend that into circulation without it being inflationary. That does music to everyone's ears, so it is possible.
Would it not be not music to the ears of the banks, though, who are getting record levels of profit when, we're with the banks, but surely a bank.
Yeah, it is a struggle, because there are lots of very powerful, influential people who do well out of the current system. So yeah, not easy. I would look at that graph of the money supply doubling every decade and just think, that has primarily been funded through ever-increasing mortgages. But now the current generation, just lots of people are just thinking the mortgage is just so out of reach. So I think that avenue of money creation will suffer, and then you're looking at either businesses or governments to take it on, neither of which are in a good position. So yeah, I think there's only so far it can go before we have to have those sorts of conversations.
Can we not just run higher interest rates for years to control money supply instead?
So to control the money supply at present, so the central bank, there's some numbers in central bank. So like ANZ, for example, has an account at the central bank, or the Reserve Bank as it's known in New Zealand. And yeah, that's supposed to be how much money ANZ has. So if the central bank wants to influence that, they can make interest rates more expensive or cheaper and so on. And that's supposed to make ANZ's balance sheet more healthy or less healthy, and they're supposed to react accordingly by restricting the amount of loans they make or whatever. But it's a very indirect way of doing it. And under this system, if you want to increase the amount of money in the economy, ultimately you need to encourage people to just walk into a bank and organise a loan. And there's only so much you can do with interest rates. You can make it really, really cheap, but still, someone in Auckland looking at buying a house and just thinking, no, I'm still not walking into the bank to organise a loan.
Maybe last one. It's great.
Yeah.
So I guess, as you touched on it before, and as well for the Great Depression, this idea that these economists have suggested this thing wasn't really the motivator to then change the thing. The thing was the great upheaval and societal pressure. So is that not more the motivator that would eventually lead to the system?
Yeah. I mean, I would hope rather than a revolution, we've had an evolution from people like me slowly promoting it. But I'm not sure if it's possible. All right. Thank you.